If it's not possible for the Queensland property market to rise further, will it hold level for the next 10 years? Put your Oracle hat on, Steve.
Taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome to the Total Money Management Podcast. We're going to be going over the week that was October 21 to 25. How we doing, gentlemen?
Good.
Did you see the tornadoes in Kangaroo Point yesterday?
Oh, Jesus, straight into
What?
Tornadoes in Kangaroo Point.
Oh, it was pretty weak.
Oh, it's still a bloody tornado.
Oh, Jesus.
I was
Mate.
shocked.
The Americans would laugh.
I know.
No, I got pelted with hail, though. On the
Oh,
way
did
home.
you?
Yeah.
I didn't get it looked really ominous. We had a huge crack of thunder, and then it was like zip, nothing.
Well,
Like a spit of rain. Anyway, let's get on with it. Have we got a new format, gents?
a little bit. So
Oh, okay.
it's come to our attention that maybe we've dragged the week that was on a little too long. And maybe we've been doing that for a little longer than we should have. So,
Because Steve won't shut up.
well, you know, there's three doing the dance. So, look, we're going to try and keep the week that was to around 20 minutes. So we don't keep going over the same stuff. And then at the end, we're going to start opening it up to some Q&A. So we've had some inquiries on our socials and we're going to start to work through some of those.
Yes. So we'll try and keep it to about half an hour.
And then a really big new chart at the end of the week.
Yes. So stay tuned.
Yeah, well-
right until the end.
Come on, you blokes, get on with it.
The now.
What
All
are we
right.
talking about?
Well, key issues today, crazy in spades, all in the pool, sense and sensibility, Chinese property,
Yep.
who dares losers, and UK affordability are the main topics. But kicking off with the big issue, we've just enjoyed a strong rally. We believe every asset class is expensive, whether that be stocks, bonds, real estate. No one's really sure when it ends. Wall Street thinks we've a lost decade ahead, so that we can probably expect not a lot of movement. We'll have to wait and see. It, kind of does echo what we've been saying for a while, though. Either way, we must be getting closer to the top, Steve. What
It's
do you
all
think?
expensive. It's all expensive. But it just the point being there is often what you see in market cycles is stocks are expensive and bonds are cheap, or stocks are expensive and property's cheap. What we've got going on at the moment is everything's expensive. And the reason why is because we've had, and this is going back 20, 30 years, we've had an enormous rush of debt. And therefore, when you've got excess money floating around, whether it's because of cheap interest rates or, for whatever reason, everything becomes expensive because there's lots of money about. And what we've seen in particularly asset markets, particularly stocks, but also property, because property prior to about 1980 wasn't really an investment class asset, right? Rich people might have a second property, but the run-of-the-mill nurse and policeman weren't property investors, and that all changed, and we'll talk about that in a special podcast we've got coming up. But the point being that once houses became this sort of thing that you started making money out of, it really changed it from a house into an investment. And that's had a real impact on a lot of people because there's now a lot more debt around. And that's okay if it's managed properly. But if you look at history, all property bubbles burst. And the even more on that is simply saying that and I've found this with stock markets as well, seldom do they manage to be at a reasonable price for a really long time. So if you look at the stock market, it goes up, then it crashes, goes up, then it crashes, then it goes up and it crashes. And so that's why we're sort of saying to people, you've got to understand that market cycle stuff, because if you don't, you're going to get caught somewhere. You make 400, since March 2009, the S&P's gone up like fourfold. If you don't know that, and you don't know that you are really pushing on the boundaries of history in terms of valuation, you're going to get caught.
Well, if you look at the stock market over time, over hundreds of years, it's rare that you see the average return, right? I think we've got a few charts
Yeah,
that
yeah,
we've
yeah.
shown on that.
Yeah.
Over a 200-year cycle, it's been the average about 10 times or
Yeah,
something.
yeah.
And the rest of the time, it's either been overvalued or undervalued. And when you understand that, it starts to become a little bit easier to invest, and how it becomes easy to manage your assets then.
Yeah, yeah. Well, see, this is one that always shocks me. The US market goes up more than 20% a year, about a third of the time. You know, like you think that's phenomenal. So, and just a reminder that it's up 24% or something year to date.
Yeah.
So you look at it and go, man, that's a great year. But if you look at it statistically, you go, okay, well, that's actually probably just a pretty average kind of year. Oh, I shouldn't say average, but, you know, it's like, oh, well, yeah, that's one of the 30, you know, that's one of the 30% of the times that it goes up over 20%.
There's another 2/3 where it doesn't do that as well.
Yeah, well, and the other point being, well, if it goes up a third of the time, 20%, there's going to be a hell of a downside to bring it back to the 10% average.
Yeah.
So
At some point.
at some point, that is the key, Thomas. The key is, what is the goddamn point? When?
Well, on Monday, we've got basically everyone globally investing in US stocks, which is incredibly dangerous. If something happens it's election time, so we're expecting it to be okay until December, January.
Now you've gone and said it.
Yeah. But, I won't go into it. But if something happens, we've got to keep it at 20 minutes.
It's the Santa rally, mate.
Then we're all screwed, basically.
Oh, that's a nice ending to it. Yeah, right. No,
Forgot what I was saying. Like, just throw that in there.
You guys,
Okay, thanks, Jacob.
you derailed me. Moving
Being a
on.
little bit more positive, what we're
you
trying
are.
to say there is that everybody's in the US market, right? US has really killed it. It's killed Europe. It's killed Asia for the last 10 years or so. And you know, everybody's in the US market. And that's when you got to be really careful. Right, next.
All right. Tuesday, if stock investors are rational, sensible people, then something's gone awry. And this can happen in any asset class and the corresponding cycle. Investors, you know, same sort of pattern. They're overly optimistic, bid stock prices up way above what they should be. Then eventually they sober up.
Well, all you've got to do is skim through the social media. And I think there was one guy maybe yesterday or the day before, posted about 16 times in this Facebook group saying, why has silver dropped? Why has silver dropped? Why has silver dropped?
What, in one day?
Yeah. Somebody please tell me why silver has dropped. He's obviously bought.
There's a guy who...
Because more people wanted to sell it than people wanted to buy it.
But this is the thing, right? People expect an explanation without actually understanding irrational exuberance.
Or what they're doing.
or the psychology behind it. And they think, some silver mine must have blown up or something for the price to drop. And no, just more people sold off.
All the powers that be knew he bought, and the universe is working against him.
He bought $400 worth and tanked it on him.
Everybody's gone short.
Yeah.
But it is an interesting point, because what most people don't really know what they're doing in the stock market. Mm. And the reason why is because if you manage to get lucky and make money, and we've talked about this before, the worst thing you can do is make money at the beginning, right? Because you just get this idea that this stuff's really easy, and it's not really easy, right? It's not really hard, but you just got to know the right bits to it. And that's where I think this is what you get, you know, like, oh my God, silver's gone down. It's like, dude, you've held it for a week.
Yeah.
This is the way it works. You know, like, don't start freaking out because silver's dropped $1.
It goes up and it goes down, surprisingly enough. What are these charts saying?
Oh, this is just just having a look at the one on the left there. You see the earnings per share is 92%, and the S&P index is 200 and what? 202. Simply saying what we were talking about at the start, which is people become, once you think something's on a roll, you want to get on it. Right, and that's the momentum part of the cycle, and we're still in that momentum part of the cycle. The mean reversion part is momentum, but it's on the downside, right? So everybody wants momentum on the upside to avoid the downside. But what I'm saying there is when things start rising, everyone jumps on without saying, well, hang on, the price index is climbed out way ahead of the actual earnings. And so that's where you get the problem where people are bidding it up and not looking at the earnings, right? And they're buying silver because silver's going up. And it's like, okay, what does it earn? I have no idea, but it's going up. And it's like, okay, that's not a really good foundation to start investing on. Right.
Well, I think the latest news was China are hoarding silver or something. One of those countries are hoarding just billions and billions of silver.
Yeah. Well, the same thing's going on at the moment with gold. Right, gold's at all-time highs or close to it, and there's the argument out there is central banks are holding more gold, and then the subtext to that is we're going to have a huge crash because the central bankers they're all holding gold and they know what's coming. Nobody controls the global economy, right? And all these conspiracy theories, but nobody. It's just simply too big, right? And if you look at Wednesday, we're talking about China, the Chinese home prices. This is why we keep repeating that governments can't haul property investors out of the market at the same time with everybody, where nobody loses, right? Yeah. That's not the way markets work, right? And it's not a market if you have no losers. Right, and this is what people need to understand. This is what I've been talking about, the same with Australia. Albo and Michelle Bullock are not going to save property investors,
no.
Right? Because that's not their job, And and if the all-powerful Chinese government can't save their property market, well, why do we think that Albo will save ours? Even if we have more immigration or anything like that, and that's again saying, look, you can't just keep shoving 500,000 people into Australia. Now, you can do it for a short space of time, but you just can't do it every year, right? Because you do get social problems and housing problems, etc. So it's got to stop. And then the problem is when it stops, you've got to say, okay, how do we keep it steady? Well, history's shown that that's not the way it happens. And besides that, if I said to you, Jacob, you've got an investment property, you're negatively geared, and you're losing $200 a week, but good news is the price is not going to fall. Now, what you're saying is, well, okay, Steve, but now I'm losing $200 a week for 25 years while I pay this off. It's like, yeah, isn't that good? Right? That's where you start to go, this is not the investment I thought it was.
Yeah. Well, right. when I went down the rabbit hole yesterday talking to you blokes about the new TMM headquarters in the south of France, which is a 17-bedroom castle, by the way, if anyone's interested. But it's $1.8 million, this 17-bedroom thing in the south of France. And I was and then I went down this rabbit hole of, I wonder what's in Italy, I wonder what's in Spain, I wonder what else is in France. And there's just vast land and vineyards and houses for under $1 million Aussie dollars.
Why would you want that? You could get 3 beds in Paddington for
900 a week.
But I was thinking, to your point, Steve, if those European governments can't save, because they wouldn't have been that price 10, 20 years ago, whatever, in relative terms.
I think you'll find, I could be wrong, but I think you'll find the maintenance on those is...
more than what you're spending.
Yeah. I had an Art Deco property once, and let me tell you, mate, they're beautiful to look at, but they cost, they're like a vintage car, right? You look at it and you go, oh man, that is beautiful. But you don't realise it costs you $400 a week in keeping it tuned and maintained and spotless and stuff because it's old, right? And that's the same with these chateaus. You look at them and go, oh man, that's beautiful. But then you figure out that in winter the heating bill is, $25 grand a year, right?
Rugged up in the east wing.
Yeah. You're all and you're ripping the panels off the wall to keep warm.
Yeah, but then there's dollar houses in Sicily. You can buy a house for $1.
Yeah, but again, you've got the Italian government sort of says, yeah, here's your house. It's 4 posts.
Yeah,
and essentially you've got to rebuild it.
Yeah.
And
anyway, stop ruining my dream, Steve.
I know, but if it's
Jacob's like, I have $1.
Just
got a few dollars.
Just go and buy something on Lake Como.
Oh, I looked at that. I was like,
but anyway,
million.
the point being, governments governments can't bail out markets unless there's an absolutely massive implosion like they did in the GFC.
Yeah.
And even then, people lost money. And, you can say, they bailed out the banks. Yes, they did, but you're not a bank, right? And there were plenty of people who lost money, right? That's what I'm trying to get across to people who have investment properties who are negatively geared and relying on the capital gain, right? If the capital gain stops, why the hell are you losing $200 a week, right? And people say, it's going to come back after 25 years. It may well be, but you get to the end of it and go, I sold it for $3 million and it cost me $3 million. You didn't make any money.
Yield on it.
Yeah. Well, Thursday, property again. The big problem being that we use leverage most of the time, which is obviously really, really beneficial on the way up, but can be a disaster on the way down. And we haven't seen it on the way down in recent history, in Australia anyway. So
it's starting to the markets this week. Now, bearing in mind we're early November, the markets in Sydney and Melbourne are starting to roll over a bit. And that's why I say, with what I'm trying to do here with this is give people a constant signal that the markets change over time. And what we're trying to do for people out there is say property owners with the wrong type of home risk, price falls, right? Even years later, 42% of homeowners struggle to pay their home loans in August. So what we're trying to do is show people that, listen, these bad debts are rising. Listen, more people are becoming financially insecure, and that's what rolls over markets. And the problem with property is, like you said, Tom, it's absolutely wacky-do on the way up, but it's a bloody nightmare on the way down, right? Especially if you can't capture that gain. And if you buy it $1 million, Jacob, and you sell it to me at 1.5, and I make the mistake, like in the stock market, of buying silver right at the top and going, woo, I'm going to make lots of money. And then it starts rolling over. You go, hang on a second. Right? Then it quickly goes to 1.4, 1.3, 1.2. You're now down $300,000 and you're going, this is a disaster. Right? So that's why I say everybody holds a property or a stock. Like every one of those things is owned by someone. And what that means is someone's going to lose out. That's the way market cycles work. Right? So it's ugly. And because Australia's had a strong market for so long, people just assume that everyone's in there making money. Right? And I can tell you, I know people who haven't made money out of property. Right? Now, it's not the majority, but I'm saying if you do it over time, not everybody can be a winner. Right? That's just the way it works.
Yeah. I mean, we're in a luxurious position where we get people reach out to us saying that they're the one that they haven't made money in property, or they know their friend or whatever has made money. And it just reinforces it. But to reinforce it even more, and on the theme of everything is really expensive, back in the motherland, the UK, the 2/3 of people can't afford to buy a home back there either. Like my sister is literally saving up a deposit. She gets to a threshold that she feels like she needs to be at to go and buy a house.
And it's moved up 10%.
And it's moved up 10%. She's like, shit, I need to go back to work and double down. Then she gets there again, and then it's like, no, I can't afford to do that. And now it's just creating this whirlwind of, should I actually buy? Should I not? Like, what do I do?
There's huge anxiety about it. And look, as I said before, the fundamental problem is income inequality, right? People are not being paid enough where they can afford a mortgage, right? But we're going to deal with that, in a few weeks, in the property special. And I just wanted to, in the short story, I've just got lots of stuff there about the war. And again, just reiterating, I've got there Australia buys $7 million worth of US missiles, right, for the greatest arms race since World War II. Now, I can tell you this week, which you'll hear next week, Australia has spent $21 billion buying missiles. Building long-range missiles. if Australia came out and said, listen, we're going to spend 21 billion on XYZ, most people would go, oh my God, but we've spent 21 billion on missiles and crickets.
Yeah. Not a boo.
Well, if you're my enemy and you build long-range missiles, guess what I'm going to be doing? Right? That's the way it works. And that's why I'm saying this war stuff is really, really serious, because it's changing the whole pattern of the way we've operated over the last 30 or 40 years.
It's making people have more jobs though. Spending 21 bill.
Someone's going to be making money out of it.
Oh, actually, I won't tell the story. I won't tell the story. I'll tell it next time. What's next? Chart of the week.
Chart of the week.
When bonds yield more than stocks, it means stock investors are taking large risks.
Yes.
For a little reward.
There's a study out called and I put it in the newsletter a while ago, called it's a terrible name, the Bond Stock Earnings Yield Differential. And what he's saying is in that chart, what you have to do when you invest is you have to think about risk. Now, if I said to you, Tom, you put your money in a bank and I will give you 5%, right, which is generally what you can get now. If I said to you, Tom, you can invest in stocks and you can get maybe 6%, you quite rightly would say, well, hang on, Steve, if I have a potential, if I have a situation where I might potentially lose money, well, I want to be compensated for that. And I want 8%. And if I say, Tom, I'll give you 6%, well, quite rightly, you should say, actually, I'll stick with bonds at 5%. And then when you come back, Steve, and go, market's crashed, I'll pay you, Tom, I'll pay you 10%. You go, okay, now I'll take the risk, right? And it's the difference between the yields. That's all it is, right? Stocks are currently yielding about 3.5%. Bonds are yielding about 4%. Why would you invest in stocks if you've got a potential to lose a lot of money when you can get 4% in bonds? Right? That's the way you want to think about it. And most people don't think about it that way.
No. Well, they just get stuck in this. I'm going to make so much money.
Buy silver.
All right. Well,
hey ho, silver away. Right, what do we got?
That wraps up. We'll talk about this in a second, but I just wanted to move into more of a Q&A. We've got a couple of questions from the socials over the last week or so.
Oh, this will be fun.
They're both actually on property, which is hilarious. But the first one is, what will the impact be on property with the Olympics in 2032?
Not much.
It'll quadruple.
Don't say that.
With 100% no.
The studies show the Olympics are only valuable mainly for developing countries because it allows them to spend a bucket load of money developing infrastructure which can then be used later on, right? So if I say we're in Nigeria, right, developing country, righto, we're going to get the Olympics. Okay, cool. Righto, we're going to build lots of roads and stadiums, and then after that, the private sector says, well, cool, we can use that road and we'll build houses and factories and all that sort of stuff. That's fantastic. The problem is if a developed country like Australia and a developed city like Brisbane say, hey, good news, we've got the Olympics, we're going to refurbish Lang Park or, Suncorp or those other places, that doesn't really add to property prices because there's nothing new going on, right? And my argument is, well, the studies show that the Sydney Olympics, property went up a little bit, but what the study showed was it wasn't because of the Olympics, right? There's just other reasons why. And if you have a think about it, my argument would be, why the hell would I want to buy at Wollongabba when they're going to have the Olympics? Like, it's just going to be a horror show. Like they said in Paris, most of the Parisians went, man, we're getting out of Paris for the 2 weeks, right?
For a month or so.
Yeah. So, the answer is not much. What you have to watch out for is people going, oh, prices have gone up in Wollongabba. Yeah, that's the Olympics. I mean, it's 8 years away.
Yeah.
I mean, God, Jesus, but you know what I mean? Like, oh, I'm going to get in early and buy in Wollongabba. Oh, I've got to get in 8 years before it happens. What, a 2-week event?
Yeah, and what happens after it happens? Most of the stadiums that they're building are never used anymore.
Yeah, because they've realised, Jacob, that if you spend lots of money, and the Olympic Committee used to go, oh, you'll get all this economic development, blah, blah, blah. Bullshit. They don't, because it's in Paris or LA and places that have already got established infrastructure.
Yeah.
And so what countries said was, well, really, it's just a tourist event. And what we'll do is we'll refurbish existing places, right? The footy clubs and the cricket clubs, they all go, oh, you beauty, we're going to get a new stand and all that sort of stuff. So that's good for them. But the property around it doesn't change in any way. Like the government doesn't say, right, you've got to knock down all those houses and build, an absolute bucket load of units for 2 weeks. And this is what I mean. When you get into the markets, what happens is people start equating all sorts of, garbage ideas with, oh, it's going up because of property. It's going up because of the Olympics. And it's like, mate, it's been going up for 15 years.
Yeah. All right. Well, I think that answers that. And the last question is from Bailey. If it's not possible for the Queensland property market to rise further, will it hold level for the next 10 years? Put your oracle hat on, Steve.
You got your crystal ball?
Yeah, that's an easy one, Bailey. Thanks for that. Look, I have no idea. But the argument I put forward is property as an investment is expensive. The yields are not that good. Brisbane prices have gone gangbusters. Best of luck. It's the same with stocks. I'm not against property because I'm saying the US stock market, the Cape's at 38. Well, best of luck if you want to buy now.
Yeah.
And I'm just saying the same thing. That's why I said at the start, everything's goddamn expensive.
Yeah.
Property's expensive. Stocks are expensive. Bonds are expensive. Bitcoin's at an all-time high. Gold's at an all-time high. Silver is just below.
Well, in my mind, I think people tend to ask the wrong question, which is either will it hold or will it increase, rather than what's the yield, is now the right time?
If I hold it for 10 years, how much am I going to get out of it?
Yeah. When are you buying? There's all those questions that need to come before that. So the answer is who knows?
Yeah, maybe it'll go up a bit. Maybe it'll fall
Yeah.
a little bit. Maybe it'll fall a lot.
Yeah.
Maybe it won't go anywhere.
Yeah.
Yep.
You just need to say, I'm positively geared. Okay, well, if it goes up, that's a bonus. But if you're negatively geared, you're really hoping it goes up because you're losing money.
Yep.
Which brings us to the
valuation chart.
the diagram.
Earnings per share and valuation.
All I want to point out here is really, really simple. Up on the top left-hand side, you see the unemployment rate, okay, which is 2.5 to 4.4. This is US, by the way, okay? Now, excuse me, the Cape ratio is currently 37, okay? So we're dealing in the top line.
Yep.
Now, unemployment in the US is about 4.1, I think, maybe even a bit lower. Okay, economy's going really well. They got real growth of 3%. They're having an investment boom, right? Government spending lots of money. They're building lots of bombs and bullets. Things are going really well. Okay, but the Cape ratio is at 37. Okay, if you look at that, you see the forward average returns are mainly negative up until the first 5 years, right? Now, look at the second line. When the Cape ratio is below 25 and the economy is still in the same way,
It's gangbusters.
right? So this is why I say to people, the stock market's not the economy. The value is what matters, right? Not the price,
Yeah, that's really interesting.
right?
So-
And that's why I'm showing you here. When you look at it, it's really simple. Is something worth $1 that you're going to pay for it? If it's worth $2, absolutely. If it's worth 80 cents, it doesn't matter if it's $1. So you know the price, big deal. What's the value, right? And that's why I'm saying, like now when times are really good, no one can see a crash coming, including me, right? But all I'm saying is I don't look at it that way. I just look at it and go, man, that's an expensive stock market, right? And look back in history. Oh, what's happened when it's been like this before? It's been awful. Okay, well, I'm really pushing the you-know-what uphill. That's all I'm trying to point out to people.
That's really interesting. And if you want to get a hold of it, is this anywhere to look? We'll stick it on the podcast notes. We can.
Yeah. It's
put it in
part
the
of our
notes.
it's part of our Well 2 program. But
Yeah.
it's a really, really important point, because what I'm trying to say to people is, please stop talking to me about the price. Right? You've got to marry it to the value. I don't care if you can get something for $1. The question is, but is it worth $1? Right? Because you want to get it for 50 cents, and then you go, hey, even if I'm wrong and it's worth 80 cents, I'm still up 30%. Yeah. Right? Or I can still make money out of it. The mistake is saying, I bought this property for $1 million, but it's actually only worth 700,000. That's when you get a problem, right? Or you say, like this thing, what I'm trying to show here is people going, mate, the economy's booming, the markets are great, don't worry about it. Yeah, you'll be fine. And what I'm saying is, no, you are most likely overpaying for gold, Bitcoin, stocks, property, your pet dog, the car, because everything's really expensive, because people are saying, oh, everything's really great. It's really great. Yeah, that's absolutely worth 1.2 million. So there you go.
Mic drop.
Something to ponder.
All right.
Well, as we kind of mentioned earlier, the week that was is available. Go on the website. You can sign up. It's free. Or jump on YouTube. You can kind of play back the podcast that way. You'll get access to all the graphs and charts that we've kind of spoken to. Thanks.
Done.
Cheers,
Thanks,
folks.
everyone.
Cheers.
As always, remember, we don't provide financial advice.